So these are the moves that we made today. Here we go. Starting with UPRO. So I bought some UPRO today because the market has had a nice pullback after the breakout from the 200. So if you look here at the chart, you'll see that the market broke past that 200-day moving average, the yellow line. And when we broke past the red line, which is the 10-day moving average, I believe, we pulled back. We had 3 consecutive down days afterwards. 1, 2, 3. Each one of those candlesticks is a day. 1, 2, 3. That's the 3-day pullback rule. And you kind of knew today was going to bounce, no matter what the news was. Yes, the Fed reported something on interest rates and how, inflation is dropping. You see why we bought UPRO today. We pulled back to the 10-day moving average, and it's the perfect 3-day down rule to add to your position. Plus, again, we just broke out of the 200-day moving average, which is this orange line. I mean, we've been failing this line every time we approached it, and now it looks like this time could be different because all the moving averages are close and converged and consolidating together instead of here where they're fanning apart like a waterfall. So we've had tons of videos on that on our channel, saying that the market's broken past the 200-day moving average. This is a buy, a screaming buy. Buy passive income names in the stock market. Don't just buy stocks. Buy passive income names because they give you the best of both worlds, up days and monthly dividends. And this is the S&P. So we bought UPRO, which is the triple S&P. So if we buy 3,000 UPRO, it's like controlling 9,000 S&P. And yes, the S&P had the pullback to the 9-day moving average, and it has, you can see here, it's clearly broken out of the 200-day moving average. The charts look a little different since UPRO is triple leveraged and decays some because of its leveraged characteristics. So as you can see, we also made $200 today because we sold some FNGU. You saw that in the alerts. We trimmed some FNGU because it's 100% maintenance. Our core position was 2,000, and now it's at 2,400, so we trimmed 400 to keep the core position at 2. We've been trimming FNGU, and it's just been its own almost income machine. As the market rallies, you just trim. If it has 2,000 in it and it goes up a couple $100, you trim 200. You just keep doing this, and it pays down my margin. So the other moves that we made today, after UPRO, we sold the put on Want. And I thought this was an interesting play because I closed HIBL yesterday for a $600 gain, and HIBL that's the S&P high beta ETF. They have some consumer discretionary like cruise ships and things like that in HIBL, but I took the profit. So where am I going to get the exposure from? So I went back to Want, which has Tesla as one of its top holdings and Amazon, which are both really cheap. Well, now they've had huge runs, but I went ahead and sold one put on Want, which, as you can see here, they gave me $800 for selling one put on Want. $30 strike price, $8 premium, roughly $7.80. So $8. That puts my cost basis at 22. So 30 minus 8 is 22. So that's our cost basis. So if the stock drops to 22, we break even. And so let's see where Want is on a current trading basis. In the open market, Want is at 25. So we have 3 points of cushion there. Most people are playing Want at 25. We're playing it at 22. So I thought it was a good risk reward play to way this was a good risk reward play on Amazon and Tesla being so cheap, and they are big parts of the market. Want has been absolutely beaten down over the last year. However, the largest holdings were Amazon and Tesla. So, see, Amazon, Tesla, largest holdings, Home Depot, Nike, all these have been just absolutely taken to the woodshed in 2022. So they're all bouncing now. So I sold the put on one, so I got $800 there. So that lowered my margin by another almost $1,000. So the margin's at 203. So that gave us the money to then buy $500 of HIBL outright. See, we bought $500. We're already up 5% on our position in HIBL because today was a big reversal day after the Fed spoke. So we got 5%. We're up 5% on HIBL already after already making $600 on it by selling the option on it. We bought the fund outright, the ETF outright, just like UPRO, because the market has had the huge breakout and now it's pulled back, and I want more exposure onto the market. I want to benefit more on the upside in the market, and how else can I do it safely? And I thought 2,000 UPRO. I'll add to that and make it 1,000 more when I get a chance. We're up 3.5% already in UPRO. $70 is nothing. But when you add all these different positions in 70, 50, 70, 50, then it makes, for a $2,000 up day, which was nothing. We're only at 0.28 today. We've had much bigger days. We had a huge week last week, so a lot of our positions are consolidating. I mean, we're having $10,000, $15,000 days last week. And so you see our brokerage, we're up 27%, the NASDAQ 13, the S&P 7. So today was actually kind of a slow day, even though it was, a good day, and we still made plenty of money. We don't care about the money, I always say on this channel. We don't care about 1750. We care about, did it stay in line with the market? 0.28. Was that close to the market? And it looks like it beat the NASDAQ up here. I'm not sure if that's updated properly, but we've been beating the market every day this year. So it's okay to have 1 or 2 days of not beating it, but we're still up, $1,500 or whatever it's saying here. So that was the third move we made. We bought UPRO, sold the put on want, and then we bought HIBL. And we paid for HIBL by selling the put on want and taking the profit on HIBL before. So we're actually at a net credit in HIBL. We still had $500 to spare. So but then I went ahead and sold puts lastly on Bitcoin. Let me just make sure on my list, was there anything else I left out? Oh yeah, FNGU, I already told you about that. And as far as buying, a little bit more of Soxel, I was just increasing my hedges there. I was just rebalancing them. It's nothing really interesting for you guys. Although I will say, I need to say this one time. I've made tons of comments about my hedges, but never really explained I think the brilliance of them. See, let's say take yen for example. Yen at $50 strike price. We got $17 for it. So our true cost basis is 33. So we have 3,300 exposed. We can potentially lose 3,300 if the fund were to go to zero, which it wouldn't, but we could potentially lose 3,300. I expect we lose half, so 15, on a terrible year. So we lose 1,500. Okay, well, if we have 500 in yang, which is the short, we have 500 in. Yes, we're down on it 29%. We don't care. We're down 200, but in yen we're up 483, and we got $1,700. So we're up $1,500 if you want to go by 17 minus the 200 that I'm down in yen. Okay, so we're up $1,500 in this position. But the brilliance of the short is that while the short won't make me much now as it falls, if we really get that, we go down to our cost basis of 33 and then we fall 50% from there. So I'm down $1,500. Well, this would be up about 100% or 200%. So the 500 would turn to 1,000 and the 1,000 would turn to 2,000. So we would actually win no matter which way it goes. If we crash lower, then our short actually works. If we move lower slightly, then our short does nothing, but we collect tons of money on our premium on the long side. If we move violently lower, then our short ends up catching up and paying for the whole position anyway. But we use such a small amount here, 500, and some of these others 300 on Soxel. You just keep enough in there, 300, enough to help you to where when if the underlying index, which is an index, so it's not a stock and it won't tank, but if it did tank, the underlying index, these shorts would actually start making up for the position. The last thing we did, we sold Mara, okay? Bitcoin. How else do you want to play Bitcoin? Do you want to risk your dollars and get no income, and you never know if Bitcoin's going to actually move higher, or it could crash and go lower on you. You could do that, or you could go to Mara here, which I'll show you. And today we sold 2 at $12.50. So look at $9 is what we received, $900. So we received $1,800 for doing 2 of them, $1,800. Knocked down our margin by another $1,800. So let's just look at one contract, $9 on Mara. Strike price is $12.50. We got 9. So $12.50 minus 9 is $3.50. The stock is currently at 6, so it has to fall 50% for me to just break even. So the stock's actually at 7 now. So I sold it at a good time when the market was dropping today. Look, it was at 60. I'm not saying it's going to go back to 60. I just want it to finish somewhere where the current price is, or above my true cost basis, which is above $3, which I think it can if Bitcoin can. If Bitcoin ends up failing, well, at least we, mitigated a lot of our risk, whereas everyone else is just going to get caught holding the bag outright. We'll just make 1 month of dividends to make up for that loss, whereas everyone else has to, go back to work or, take out a second mortgage or something. We can just live off these dividends, which are about $95,000 a year. You see here, it's about $97,000 a year. You saw the performance. We're beating the market. So anyway, again, hope you enjoyed it. Stay tuned for further videos. Thanks.